Good morning and welcome to the Killik Co market update. Big news out this morning from Unilever. The company has announced it will be scrapping its plans to move its headquarters away from the UK. So Unilever has quite a complicated corporate structure, half in the UK and half in the Netherlands, and it had wanted to simplify that and move everything to the Netherlands. However, UK investors were very much opposed to that plan. Unilever at the moment is a very large constituent of the FTSE 100, and moving its headquarters away from the UK would have meant the shares would have had to have come out of the FTSE 100. That would have forced FTSE 100 tracker funds to sell the shares, and it could have caused some weakness in the share price. So that's the reason for the opposition from UK investors, and they're very happy this morning that Unilever has announced it will not be going ahead with this plan. So Unilever shares are up this morning in early morning trade. And this week we've had some weak data regarding UK car registrations. If you have a look at this chart here, it shows the number of new UK cars being registered each month over the last 10 years. And as you can see, there's always a spike in September and March when the new registration plates come out. But the most recent spike for September just gone is much lower than previous spikes. And in fact, it's 20% lower than the spike for the previous year. So this does show there is some weakness in the UK car sector. There are a number of reasons for that. One is potentially the uncertainty around the new tax on diesel. That's probably putting people off buying new cars in the short term. Another reason is probably Brexit concerns. And thirdly, there is a new EU emissions test. So new UK cars have to go through this test before they can be sold. And apparently because this process is quite new, there is a bit of a backlog there. So manufacturers are struggling to get their cars approved in time to be sold in time for a particular month. So once that backlog is cleared, we might potentially see a bit of an uplift in these new registration numbers. However, in the short term, we are seeing some weakness in the shares of car manufacturers. For example, BMW had a profit warning last week, and that's feeding into weakness in the shares of companies that make components for cars. For example, Continental, which makes a lot of tyres. So please do give us a call if you do have any shares in this sector. And also this week, Amazon has raised its minimum wage to $15 per hour. So in the short term, that's very good news for Amazon employees. However, over the longer term, it could actually lead to less jobs. So large companies such as Amazon are continuously having to weigh up whether they should employ humans or use automation. And as wages go up, the automation actually becomes more cost effective in comparison. So over the longer term, as wages rise, we would actually expect to see less jobs and higher levels of automation. So please do give us a call if you would like to hear our thoughts on warehouse automation. Now, this rise in wages from Amazon could actually have connotations for US interest rates. Now, Amazon is a very large employer in the US, and now that it's raised rates, we would expect similar companies to follow suit. So that could cause potentially a rise in wage growth across the US. Now, the Federal Reserve has actually given lack of wage growth as a reason for not having raised interest rates in the US more quickly. So if wage growth really picks up, then we would expect to see interest rates going up more quickly than the market currently expects. Now, still on the subject of US interest rates, there was a rise in rates in the US last week, and that has corresponded with a rise in the US 10-year bond yield. So have a look at this chart here. You can see there has been a clear rise over the last 2 years, and now the yield is well over 3%. There has been quite a rise in that yield recently, and that implies that investors are expecting interest rates to rise still further in the future. So we've been having a think about potentially what companies and what sectors could benefit from this. And one potential sector is US banks or US financials. If you have a think about how banks operate, they take in deposits from savers and they pay a very low interest rate on those savings. They then lend out those deposits to borrowers and they charge a much higher rate of interest on those loans. The net interest margin is what the banks earn, and it's the difference between what they pay on the deposits and what they charge on the loans. Now, as interest rates overall go up, we would expect that net interest margin to rise. And in fact, if you look at this chart here, this shows the average net interest margin of US financial institutions over the last 2 years, and you can see it has been rising over the last 2 years, very much in line with the rise in the yield on the US Treasury. So if that yield goes up, we would expect this margin to rise along the same pattern. So definitely something to keep an eye on there. And moving on to the week ahead, we have actually got 2 US banks reporting, and those are JP Morgan and Citigroup. That's it from us. Have a great weekend, and we'll see you next Friday.